You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Today is 2/25/2021. Well, we've seen much volatility, to put it charitably, in the market, much uncertainty, a lot of fear. When usually you see a lot of fear, that means there's a lot of opportunity there. But the market is trading at record high valuations. And do valuations matter anymore? Is this time really different? What are your thoughts? Why don't you send me an email to kl@kerrylutz.com. Let me know what you think. We're going to have somebody on here who has his own opinion and has profited handsomely by it, as has his subscribers. I'm talking about Dan Ferris, editor of Stansberry Research's Extreme Value. You know them well, monthly investment advisory focusing on safe yet profitable stocks in the market. And let's find out from Dan how you actually accomplish that. You've been doing this now, Dan, it's 21 years. You've been editor for 19 years, and your successes are really legendary. We see them, it's remarkable, major gains. And now, so many of you out there are thinking, is it time to get out and buy safe investments like treasuries or defensive investments like precious metals? What do you do? And that's why we've got Dan on. Dan, welcome back. It's great to have you. So what is a poor, hapless investor to do who doesn't have your insights and your knowledge?
Well, there's a lot you can do. I probably can't help you with the poor, hapless part. You got to take care of that yourself. But yeah, right now, the way you frame it, it's sort of like we're talking to new investors. Man, it's an extremely dangerous time actually to be a new sort of novice investor. In fact, that's one of the hallmarks of this moment, is that new novice investors with a little bit of money have flooded into the market and created crazy effects in stocks like, I suppose Gamestop is the most recent famous example. That business is not worth much. They sold a good part of it maybe almost 4 years ago, and what's left is not really that valuable. And the stock was like, it was like $3 within the past, I think, year or something. And, it hit like 400, almost 500. So that's crazy. And novice investors largely created that effect by buying the stock and causing large institutions that were heavily short to have to cover, which meant a lot of buying all at once. So, and you can start to believe that you know something. If you buy a stock like that at 10 and ride it to 200 or 300, you can think that you're really smart. But this is the moment in history when you have to beware of confusing brains with a bull market.
Yes.
Right?
Yeah. As Rick Rule says, one of my mentors, never mistake a bull market for genius, right?
Exactly. I got this quote from the same person. Yeah. So this is the moment at which that mistake is most often made by the most people all at once. So that's the first thing that I would tell the poor hapless investor. Be very, very, very careful that you don't think you're smarter than you are about this. If you recently made a large speculative gain in a company that is probably not worth anywhere near where it's trading today. That's the first thing.
Yeah, so true. And I can totally empathize with that. I wasn't a novice investor in 1999, 2000 during the dot-bomb craze. But I wrote an article, it's the dopamine stupid. And when you're making money doing nothing, literally, but picking stocks and throwing darts against the wall, it's euphoric. You get a high from it. And you start to believe your own BS, you become a legend in your own mind. And like you said, that's when, it's danger, Will Robinson. You better pull back and take a really good look in the mirror, because dopamine is going to get you into trouble, because dopamine is released by the pleasure center of the brain. A lot of it's physiological, the way we act in the market We don't even know we're doing it. You get lucky, or maybe you weren't lucky. Maybe you actually had sound reasons for what you bought, but then it exceeds your expectations. You make a boatload of money, and then you think that you've got this thing down. I know how it works, and I can keep doing this and doing it. It's like when you go to the casino your first time and you're at the blackjack table and you get this run and you win thousands of dollars and think, hey, I can make my living playing blackjack, right?
Yeah, no, wrong. Yeah.
Yeah, and it happened to me during the dot bomb. I didn't think that this time was different. I knew it was going to end, but I knew that it was really it was going to keep going until it was going to give me a magical signal to get out. Right.
Everybody thinks that. Everybody thinks, oh, don't worry, I'll just get out before it's over. I'll get out at the top. I won't wait. Then they're in it, and they learn the hard way that nobody knows where the top is. And for an individual stock, that's true. And for an overall market that can affect, literally thousands of stocks, that's even more true, because the topping is sort of a process that takes time. It's not an event, right? Bottoms tend to be events. Top is a process, and we're seeing there are signs that the process is well underway today. And the Gamestop episode that we pointed to, that's a sign of a topping process. Certainly in that stock, but in the overall market too.
Hey, and that's such an interesting thing. We got these things called SPACs, and they rear their ugly head every bull market, especially near the top. But they've been called different things over different markets. Originally blind pools, then they were called blank check companies. Now it's a SPAC, a special acquisition company, something like that. That's another flashing neon sign, isn't it?
Sure. These are many pools of capital. And nowadays, the thing you do with a SPAC is you pick a hot area, right? And you say, we're going to raise a bunch of money in a SPAC, and we're going to go out and buy a blockchain software technology company or something. And then everybody gets excited. Yay, blockchain, anything with the word blockchain. And meanwhile, most SPAC deals are crap. They're just garbage. So, there's that. You got to be careful. I'm not saying there aren't great deals in SPACs. It can happen, right? DraftKings was a SPAC deal. But most of them are going to be garbage.
Yeah, and they're just Wall Street's latest configuration of an age-old technique to separate investors from their money. And
right. The techniques. There's nothing new going on. And it's the same with ETFs. Cathie Wood's ARK investment management ETFs. All the charts are ballistic, right? They're straight, ballistic missiles straight up. Every ARK ETF. Well, what does that tell you? Look, a ballistic chart doesn't correct by going sideways. It corrects by crashing. And they've lost, I think, $3 billion in assets. I think it took about 2 days or 3 days for them to lose $3 billion in assets here earlier this week, because when Tesla and Bitcoin, and they have huge positions, 3 of their funds, the top position, they got 10% or more in Tesla, and she bought more of it, which is crazy.
Yeah, because it has to go up, right?
Yeah,
it has to go up.
The money is ran out the door so blindingly fast. Between the market depreciation and redemptions over just a couple of days from Friday through Tuesday, really horrendous. So that's a sign of a topping process. And look, Cathie Woods and ARK, they get credit all day long. They started up in 2014, focused on disruptive innovation. It was the thing to do. It was brilliant. But now it's gone too far. It's gotten too crazy. And she's way too into Tesla and Bitcoin. And those things, they're not going to go up forever.
One thing you got to realize, corporations are run by people, sometimes very extraordinary people, such as Elon Musk, but they're still people. And Elon Musk is brilliant in so many ways, but that doesn't mean that the company is worth what it's currently trading at. I always go back to Benjamin Graham, who, maybe his definitions of a company worth buying are a little bit archaic, but when he described investing, and called it anything that's got a definite return that you can calculate over time and assign a value to. That's investing. Everything else is speculation. And there's been a lot of iterations of that. Is he still relevant, Ben Graham, or is he just in the dustbin of history?
No, the core of it will always be relevant. Look, valuation may not seem relevant at this moment, but ultimately it's the force of gravity, right? You can't just pay. If you have a stream of cash flows, let's just make a simple example. You have a stream of cash flows. It's $1 a year. You can't pay you can pay $10 for that, and maybe you're getting a good deal, 10%, right? You can't pay $100 for that and expect to make a lot of money. That's just not the way the world works. It's hard in equities because that stream of cash flows can grow. It can grow and it can shrink, and it can grow and shrink at different rates for different periods of time. So it's complicated. But the same basic mechanics will never change. And it provides the force of gravity. Eventually, it just all goes too far. People ask me, Kerry, they go, well, Dan, I understand you think it has all gone too far, but what makes it turn around and fall? What makes the stock market go the other way? And the problem is, at this point, the stock market is one of the fundamentals. You don't look for the fundamentals that cause stocks to fall. You wait for stocks to fall because the stock price has become the fundamental that influences what the business can do. Sky-high stock prices mean that some people are better creditors than they would have been at a lower stock price. And some people can, raise money at a much lower or even negative cost of capital. So it becomes a self-reinforcing cycle, and then eventually it just goes too far, and then it turns in the other direction.
And in the meantime, like you said, Elon Musk has been raising capital every step of the way, which is what you're supposed to do. A good CFO doesn't borrow money when she needs it. She borrows money when it's there to be borrowed at attractive terms and rates.
Yep.
And so let's talk though about disruptive technologies, because obviously our entire transportation sector is subject to a disruptive technology now. Call it Tesla, call it Rivian, call it Neo, whatever you want. But this is a battle, survival of the fittest. And if you're in the business of making transmissions now, or you make torque converters, or engines for that matter, or fuel injectors for engines, everything is subbed out. You got to be scratching your head now, wondering how long you're going to be for this world.
Don't just survive, thrive. The Financial Survival Network.
Today's show is brought to you by GR Silver Mining, ticker symbol TSX, GRSL, OTC, GRSLF, and their website at grsilvermining.com. The company is extremely well capitalized, currently has a resource of 40 million ounces of silver, and is looking to triple that number in just the next year alone. Its management team is first rate, headed up by Marcio Fonseca, a geologist with vast experience in mining operations and the financial sector as well. With all this going for it, and with silver trading over $25 the ounce, there's no telling how high GR Silver Mining will go. So go to grsilvermining.com to stay up to date on the latest developments and get on their notification list today.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Yeah, I'd like to think that if I was in that industry, I'd scratch my head a little less than most people. Because I don't think electric cars are the slam dunk that everyone else thinks they are. Because they're, underneath it all is a somewhat flawed premise. This idea of a climate apocalypse is just so imminent that we have got to rush out of internal combustion engines and fossil fuels. And another part of that that's a little ridiculous is, there's only so much fossil fuels and we're running out. We'll run out of them eventually. And that's a little silly too. The whole thing is based on a flawed premise. So the impetus is largely political.
Correct.
It's not real. Yeah. So,
you're 100% correct about it. Because, the world's coming to an end. The seas are rising. And, Nevada is going to be waterfront property pretty soon, the way things are going. Well, earth changes happen, and they happen really quickly, and we have no idea why or how or when. But it's because it's become, perception has become reality. And the other thing is that when you look at a Tesla, it in so many ways, it is so far advanced from an ICE car. Yes, it has four wheels, a steering wheel, and it drives. But what's in it is so far beyond that I think the revolution has occurred and it's continuing. And it doesn't matter how good you could make an ICE engine and how fast it can go and anything else and how quiet you can make it and energy efficient. I think the decision's been made. They're doomed. And now the technology is further going to doom them.
Yeah. I mean, again, there's narrative and there's reality, and I just feel like, sure, we'll have more electric cars on the road in 5 years or 10 years than we do now. I have no doubt of that. None. We'll have more electric charging stations, right, for all the electric cars. No doubt. But are we really going to replace the internal combustion engine wholesale in a short period of time with, are we really going to do away with the most abundant, cheap transportation fuel in history? I mean, it's just, I don't see it.
I know what you're saying, and I'm inclined to agree.
The other thing, Kerry, is like a lot of that is based on operating costs, and operating costs for automobiles are low for internal combustion engine. Fuel is cheap. Oil is cheap. It's not a big deal, the operating cost. The cost is that you're buying capital equipment. You're buying a car. And, electric cars are going to be kind of expensive and clunky for a while. And I know, Tesla has the Model 3 or whatever, but it's still, overall, it's going to be more expensive and clunky than buying a decent, little kind of entry level, low level, cheap Toyota or something like that for a while.
So the play here is stay away from Tesla, invest in the legacy automakers, select ones, or just stay away from the industry altogether?
I hadn't thought about it until I just said what I said to you, but short Tesla, long Toyota sounds like an idea worth pursuing. I'm not saying I would do it right at this moment, but I definitely would pursue it just to look at it, because Tesla's overdone and Toyota's overdone on the downside, I think. It's a little too cheap.
Interesting. Yeah, well, it is getting disrupted. And, a lot of the things like Tesla's done, they've eliminated the need for the model year. Like the traditional legacy automakers' life schedule goes on the model year, where they're going to be, the car shows, when they release them, when they go up for sale. So they've gotten rid of that. And then the concept of actually updating, making better a vehicle, because normally you drive a car off the lot and then it begins the slow degradation and eventual entropy, and then into the junkyard. So Tesla's made some progress on that front. So I just wonder, and believe me, I'm not a Tesla stock booster. I'm more the technology that I see there. But I think Toyota's got some life in it for sure. Yeah,
but no, you're right. Look, he's done a lot of great things. The way they sell cars is so weird. The dealer model, and and they disrupted that as well. And that needs disrupting, right? There's no reason why you can't just, sort of go into a store the way you can with Tesla, right? When I test drove one, I went to the mall.
Yeah.
Exactly. I went to the mall and I walked in. I said, "Hey, I want to test drive a Tesla." And we walked down the parking lot and test drove a Tesla. So
I love it. Yeah, it's great. Like, you got no shyster looking guy trying to rip you off. Well, how much is the car? Well, how much do you want to pay? And how much do you have to spend? And are you leasing? Just give me the damn price and shut up. And then, that model is definitely dated, and it harkens back to 100 years ago when the country was a lot different. The world was a lot different. So disruptive technologies, you got to be very careful when you invest in them, don't you?
Sure. The pioneers get the arrows and the settlers get the gold. You got to be careful. That goes without, well, it should go without saying. Maybe it doesn't. But you're right about, it's like, I was talking about Kathy Woods and innovative, disruptions. She was right. Innovative disruptions are really, really, really important. But that doesn't mean they're great investments all the time. There are times when they're disasters. There are times when a great business that's been around forever and makes a ton of money is not a great bet. You can pay way the hell too much for Berkshire Hathaway, and they're pounding out money every second of the day, cash profits every second of the day with an amazing portfolio of businesses. You can certainly lose your rear end on Tesla, right? I mean, it's just the comparison is a little silly even.
Well, it gets me, and then we'll move on to something else because I really want to get into like how you make money in this market. But you just look at YouTube. All right, you are a professional. You've been in this business a long time. I might not view myself as a professional, but I'm pretty sophisticated about it. And when I see some 22-year-old kid tell me how, just like Tesla is this, he's a fanboy, and they can just do magic and do no wrong. And for instance, one guy's saying, all right, I've studied balance sheets. I know you have. You're an expert. And he says, well, if Tesla needs profit, they could just take money from their deposits and add it to sales. And it's like, idiot, you can't do that. There's a thing called GAAP. What the hell are you talking about? That's just an egregious example. It's replete with them. These people have no knowledge whatsoever. As a recovering attorney, I could poke holes in their arguments all day. But you know what, Dan? It makes absolutely no difference because there's a bandwagon, there's a lemming effect going on, and nothing seems to stop it except a crash.
Right, but it's more fundamental than that even. You can't talk to them, and you don't need to, because in due time, reality will talk to them clearly. It's true.
Great point.
You and I wonder how you and I can make a living talking about finance all the time when the only thing that matters is, are you getting a return with lower risk or aren't you? And if you are, there's nothing to say about it, right?
Yeah, exactly. And what we've gotten away with is pricing risk, largely because of low interest rates, which raise all boats, at least temporarily, until they end. Then the punch bowl's withdrawn from the party, and everybody's left looking around saying, what are we doing here?
Right. In these speculative episodes, there are always things like these underlying assumptions that get blown away. And one of them you just said, I believe, I agree with you. The idea that businesses are worth a whole lot more because interest rates are low is a little bit crazy in itself. And the idea that this level of interest rates is right just because that's what it is right at this moment, the belief that the market is perfect at all times, that's crazy too.
And so it's not perfect. So how do we do what you said, earn a good return with low risk and basically do this over time, get great returns with low risk and really avoid the pitfalls of speculative ebullience, as Alan Greenspan called it.
Right. Irrational exuberance. So look, if you're going to buy stocks, and I think you should own them, you should always have a stake in all this great innovation that we were talking about. It's relentless. It's the ascent of man, the upward arc of humanity. Life is better for more people at this moment than at any moment in history, and it just keeps getting better and better. And you need to have a stake in that. So keep your stocks and bonds by all means, but also have plenty of cash. This is the time to have, 20% or more in cash, because cash, as far as I can tell, is the only true ultimate diversifier that doesn't cost you a ton of money to own it, right? You can own put options, but they cost you something. And mostly they'll expire worthless. So they'll cost you something every year that you own them, except for the one time when you'll need them. So have plenty of cash, keep your stocks and bonds, have plenty of cash, have gold, have silver, maybe a little Bitcoin. I still believe, even with the big run in Bitcoin and the huge volatility, that it's worth owning a little bit for the potential over time to do, a major multi-bagger run in addition to the one it's already done. Yes. So if you're truly diversified in this manner, I think that's the best you can do at this time.
Yeah, and cash, assuming that we don't go into a major hyperinflationary event, then your cash becomes trash.
Yeah. People misunderstand hyperinflation, I think. And a guy named Cullen Roach, who we interviewed on the Stansberry Investor Hour a couple of times, wrote a piece about this. And his point was like, to have hyperinflation, you probably need things like, a war, a major war on your home country, and you need like the massive destruction of capital assets that results from that. And, lots of people in really, really dire financial and just physical straits. It's not just like you print a lot of money, you get hyperinflation. There's other things going on, and a pandemic looks like it could be one of those things, but we're not at hyperinflation. So, there obviously needs to be a lot more. Inflation can be bad. You don't need hyper, right? All you need is just even high single-digit inflation can be really, really nasty if it sustains over time. So you need those stores of value like, gold and silver and things.
Yeah, I couldn't agree with you more. And when you say cryptos or Bitcoin, how much do you keep? 3-5%? Because so many of you out there have gone all in on cryptos. And I wrote an article, Frank, I don't know if you probably didn't catch it, but it was back in January of 2018, December of 2017, somewhere around there. And I said, sell half your Bitcoin now because half of infinity is better than a loss, because everyone said it's going to exponential infinity. And we as students of the markets know I've never seen that happen with anything yet. It'll go up over time, but it's going to crash for sure.
Yep, it's going to remain volatile. It's a highly speculative. It's a burgeoning, I would call it a burgeoning store of value, highly innovative, potential new store of value. And whether or not it sticks around, time will tell. It's only 11 years old. Gold is 5,000 years old. So, it takes time for these things to get established.
And I make the point, and I'm sure you'll agree, that if you were in Texas last week and the grid goes down and you got nothing, you don't even have water, I'm sure the cell towers were shot because they only have temporary battery backups. Bitcoin was not going to do you much good there, was it?
Well, certainly if you had it in a cold wallet, you could port it around. And if somebody had to generate, there are ways you could put this scenario together. But yeah, I agree. It's, when the whole grid is down, most people can't even access their Bitcoin because they probably don't have it in cold wallets. So yeah, it's a fair point. But you can carry your gold anywhere.
Right. They haven't printed out the Bitcoin or whatever, and or they don't have a USB stick, so they could. I don't even know how you got out of Texas. I don't think there was really any way you could do it. And they're still recovering to this point, and hearts go out to them. But that to me is like, that's a hole, because the grid, can come down at times, hopefully not for long, but it can go down, and so can the internet.
Yep. Yeah. I mean, in our modern society, the grid is life, man. Yep. Electricity is life.
For sure. And that's why you should probably have a whole house generator, or at least a backup generator with plenty of fuel, because you just never know. Once in 100-year storms seem to come along a lot more lately. So going back to your investment thesis, this is a good time to be taking cash out. One thing that I know novice investors don't do, and I've been guilty of it in the past, is when you sell a stock or an investment and you have a nice profit from it, take some off the table, right? Many of them just keep parlaying it up like a drunken gambler in Vegas who keeps winning at blackjack and just takes everything and all in on every single bet. And that's a sure way to go broke.
It's a good point. You should take money out of the stock market. Eventually, you want to be taking money out of the stock market, not constantly feeding a habit and putting it in. If you're young, you got 30 years, okay, you contribute regularly to your 401k and you're going to wait 30 or 40 years, whatever. That's one scenario. That's one thing. But, especially if you're older, and even in general, the stock market is insane. Leaving your money in there beyond a certain point is gets a little crazy. You want to You're there to come out with more than you went in with. Period. You're there to make money. And you're not there to make money just to put it back in the market. You're there to make money so that you can have it and save it for a rainy day or buy a new car or whatever it is you're going to do. It's a good point.
It's so true. It's so true. And hey, I've been guilty of it myself. I've learned the hard way several times, but hopefully I'm a little smarter now. I've been doing well, pulling money out and, like you said, putting some money away in cash because eventually stuff goes on sale, even in the stock market, even after the run-up we've had. Mm-hmm. What are you anticipating? So COVID coming to an end, probably, even the CDC models are starting to point to that. We going to see a bump up in the economy? Is that going to further drive the market, or is reality going to dawn that maybe it wasn't all COVID that caused this?
Oh, one of the good things about being truly diversified is that I don't have to predict the future. I'm just prepared for it. And that's been my mantra for the past few years. Prepare, don't predict. So I don't know. I don't know what will happen, but I darn well want to be ready for it to the best of my ability.
Yeah, such a great point. And that means having a plan. And that means that you should be subscribing to Extreme Value. Can you just tell us how we go about that?
Well, you can go to extremevaluevideo.com. We're going to have a video up. I'm not sure if it's there now, but it should be real soon. And you can learn about Extreme Value that way. You can also find me for free. You don't have to pay anything to listen to the Stansberry Investor Hour podcast at investorhour.com.
All right. And it's a great podcast, great production values, great information there, highly recommended. And if you got a question for Dan, please send us an email to kl@kerrylutz.com. I'm sure a lot of you out there do. Make sure you sign up for a free newsletter, financialsurvivalnetwork.com. Dan, really been a pleasure and a breath of rationality and sanity in what often is a very insane world.
That's a high compliment, Kerry. I thank you for it. It was great to be here.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.